A very good evening to all and a very warm welcome. On behalf of NISM, I would like to take this opportunity to welcome you all for today's webinar on financial planning and risk measures. Myself, Ami Sayed, working with NISM. Along with me, today we have a renowned speaker from the industry who will be taking today's webinar. We have Mr. Rohit Varman. He's a founder of Quantify. Before we begin, let me give a quick introduction about our speaker. Uh, Mr. Rohit has 19 years of financial service experience in equity advisory and financial modeling. He has worked with Serum Institute of India Limited, Motilal Oswal Securities Limited, and ICICI Securities Center for Financial Learning. He is currently directly involved in real-world finance automation, fundraising, and academia. On corporate financial automation side, he's working as a subject matter expert for fintech projects for asset management companies and financial modeler for private equities. He's associated with SEBI, Security Exchange Board of India, as a smart trainer, and he has conducted many financial literacy programs in Western region. Mr. Rohit is a graduate in computer science and a postgraduate in management and professional qualification in financial analysis, financial planning, and wealth management from US-based professional boards. As we are going to discuss today financial planning and risk measures. So what will be the key focus for the today's webinar? Today we will be going to discuss what measures should we look for financial planning and what are the risks associated with it. By incorporating risk measures into financial planning, individuals and in organization can make better financial and better decisions, balancing the potential rewards and potential risks as well. This will lead to more resilient financial strategy that can be withstand market fluctuation and other uncertainties. We'll be taking the questionnaires at the end of the webinar. So requesting all the participants to put their Q&A questions at the Q&A board. Our speakers will be happy to answer you all. So without taking into further time, I would like to hand over the webinar to our speaker. Over to you, sir.
Yeah. So good afternoon, everyone. And really thankful to Amir for introducing me and NISM for giving this opportunity. Of course, I appreciate SEBI for taking this initiative for so many years. Every year, SEBI, conduct the World Investor Week. I will be speaking on the financial planning and risk measure. Only thing is to make it more interactive and to be more effective. Even in between, you can raise your questions. You can put in the Q&A or in the chat box. Fine. So it will be more lively discussion. Because ultimately objective is what? We have to learn the thing, right? So better you ask in between, or if you think appropriate towards the end, you can ask in at the end also. So let me go with my presentation. Okay, this presentation I have divided into two parts. The first, what I will do is, first I will present you a situation. Okay, I will present you a case so that you can relate, right? And then we will discuss on the case. And then I will take some certain concept. And lastly, towards the risk measures, right? What are the things we have to remember when we do any kind of asset evaluation? Okay, so that is the whole objective from my side. Okay, so let me present you first the case, read the case, and please put your points. Okay, you can better if you can speak or you can put in the chat box also. Okay, so I'll go simultaneously the chat box as well as the Q&A. Okay, so here is my next slide. I hope it is readable. Let me zoom this, maximize this. Okay, so here is a situation. I have presented you one situation. Okay. In general, I have taken a person name as a X. Okay. And I have written certain thing with respect to time, like what the age is, in monetary terms, how much he is earning, where the money is going, and how much he is saving, right? So what you do is, I want you to go through it. Okay. And then I will discuss about what are the elements which we should look in the financial plan. Fine, everyone. I hope I'm audible. Everyone, just thumbs up.
Yes, sir, you're audible.
All right. Okay, good. Okay, so go to the case. Yes, fine, good. So yes. So go to the case, please. I have presented you one situation and we'll discuss on the situation and then the elements of the financial plan. Okay, and then some concepts we will see. Okay, now if I tell you the first para, right? What it says, the age 40, what the income is 2 lakhs a month, and then it says about the savings, right? So he's saving 40,000. That means 1 lakh 60,000, it is going in the routine expenses. We call it household expenses. Okay. And certain portion goes to the EMIs. You can see loans for his house, car, and other needs, right? So nowadays, loan and EMI become the embedded part or a routine part of our spending. Actually, everything is available on the EMIs. Even the holidays available on EMIs. You take the phone, available on EMIs, right? So all the things nowadays, even if you see nowadays, it is something like, buy now and pay later, right? So the thing is, there are more sellers and even the buyers are paying for it, right? Even they want to take the loan, they are taking the loan on it, right? So please try to understand, go beyond the lines, right? You think of your environment, right? We are living in such an environment where all the things are available. It is just we have to say yes, we have to accept the offer, and that object or thing is available. So same thing is given in the first paragraph. Okay. Now, the second paragraph talks about his assets and liabilities, right? So what it says, his investment include those for the tax savings, bank deposit, bonds, and some mutual funds. Fine. And he pays the premium on his life insurance for himself and his wife. Another very important thing is X is the sole earning member, right? So he's the only earning member. And uh, the thing is, what he believes, what X believes is that he can take care of the current, household expenses, and of course the future goals, right? So now please understand, a situation is given where the earning person is earning, he has some expenses, he has the assets, he has the liabilities, and then finally, the thing is, how would financial planning help him? So many people think that, if the person is doing well, then he doesn't need the financial plan. Or some people think that if I am earning less, then I don't need the financial plan. So there are all kind of perspective. People think that, a low earning person doesn't require financial plan. Some think that a high earning people doesn't require the financial plan. But we have to understand one thing. If given a situation, like this, what the situation you are seeing here, everyone needs the financial plan. So now we will see what are the elements of financial plan, right? Okay, so I can see some of the, in the chat box, some of the replies that he can invest in stocks, mutual funds. Okay, X is not having a health insurance. Very good. No term insurance cover for himself. Very good. Yes. So I can see Sumit Ghosh. Yeah, fine. So Rahul, I would help him diversify and risk manage. So good. Like some of you are aware of certain terms. Fine, good. So I'll tell you what are the things we should always start with some basic thing. First we call the budgets. Cash management, where the money is going, right? From where the money is coming. So what is the source of income? Where he is spending. So first we have to understand the flow of money, right? We call it prepare the budgets, right? I hope it is fine. Untimely death, yes. So again, Abir Ghosh, you are saying what about the uh, untimely death? What about the contingency? Very good. Okay. Inflow and outflow, yes, Avinash. Okay, good, good. So all well. So the thing is, many of the things are missing, right? And this is what the situation in most of the household in India, right? I will not say India. In fact, worldwide, this is the situation. So financial planning is not an Indian only, limited to the India. It's a worldwide issue actually. Okay, good going, right? He does not have a term insurance, fine. Okay. Beat inflation. Okay, good, Sumit. So Sumit is saying that what about the inflation, right? How he will beat the inflation? What about the instrument which can beat the inflation? Okay, not sure about his job security. Yes. What about the job? It can be anything. It can be disability. It can be some kind of regulatory issue. It can be anything, right? What about the job security? Okay, so good going. Now what I will do is, with all your valid points, what I will do is, let me go in a systematic way, and these are the elements of the financial plan. Okay, so let me go with it. So the next slide. Okay, so let's see one by one. I have written in a sequence. You can see the alphabetical orders like A, B, C, D. Okay, I'll go with the first one. You can see as a sole earning member. So one of you have said this. What about the emergency? Recently, one of you have said that. What about the job security? What about the disability? Suppose if he meets with an accident. So there are certain things which are beyond our control. Agree, everyone? So what about the emergency? So he must have an emergency fund. And now the question is, what should be the emergency fund? Now it depends on the person's skill, right? So some people say the rule of thumb is that the person should have a 6 month, emergency fund, which is equal to 6 months salary, right? So if the person, so let's say in case of X is earning 2 lakh rupees, right? So 2 into 6 is like 12 lakhs. He must have at least 12 lakhs. So this is what the thumb rule is, right? Okay, I'll go with the B point. Does he have adequate insurance cover which will take care of his family requirement? Again, one of you have said, I appreciate the point that what about the health insurance? What about the term insurance? Okay, now insurance part I will cover somewhat maybe after 10 minutes. That when we should go for the insurance, we call it risk management. So I will come somewhat after some time about this insurance part. But yes, the question is, does he have the adequate insurance? Because people go under insurance also, right? Some people can take just for the formality that, I must have an insurance. So he's just taking for the sake, right? So having, I mean, this is a valid point, right? Does he have the adequate insurance? Okay. What about, does the family have adequate health insurance? So you have said already, right? Does he have any medical policy or any policy from the employer side, right? Any group health medical policy? Now, what are his specific future expenses and how will he fund them? Now, please understand something, we call it the future goals, right? It can be children's goal, it can be buying a house, it can be any tour, holidays. All these are the future expenses. So, does he build any corpus for the future, right? So, I can see some of you are writing rule of 50, 30, 20, necessity, desire, savings. Okay, this can be thumb rules. Yes, so Nidhi, I appreciate one of the huge expenses. So Zabir, right? One of the huge expenses relate to educational saving. Okay, valid point. So the thing is, all your point is valid because financial plan is a customized plan, right? Everyone have a different situation. So we have to see the kids' education, right? Or even the higher education, the coaching fees, right? The college fees, right? All those are future expenses. Agree. Good. Now, if X has to create, I'm on the E point. If X has to create a corpus to fund large expenses in future, what is the size of the investment corpus he should build? So the thing is, he should know, like, I'll give a good example. This example is the retirement, because young people generally don't see the retirement. It is only after 35, 40, one realize the importance of retirement, that yes, one day I will retire and I will not get the active salary. So the person is totally dependent on the pension. So it's a big corpus required, right? So maybe I will show you some calculation with respect to the goal planning on spreadsheet after some time. But one is, what we are doing is, we have a situation and we are seeing from all the perspective, all the angles, what are the things he should work on, right? What X should work on. Okay, I'll go to the next slide. Okay, some more points. can these things can be applicable if his total salary is 40,000? Okay, so Sudha, okay, so I'll just you know I just want to add to the Sudha point that his salary is not 40,000. Sudha, he's earning 2 lakhs. He is saving 40,000, right? After meeting all the expenses, what he's left is with 40,000. I hope it is clear, Sudha. Okay, yes. So, Kulbhushan, yes, you are talking about retirement. Hiral, you are talking about medical emergency. All valid points. Good. Okay, so I'll come to the next point. Given his current income and expenses, is he saving enough? Again, people are very conservative. They think saving will make them uncomfortable, right? Many people think that I will be left with less money. What about my spending? Okay, so many people save conservatively. Please, we have to understand one thing. When we have to create a wealth, we have to save more, right? If we don't save, then we cannot create a wealth. So first, the basic element is the saving, right? And even like if you heard Warren Buffett, what he says that first, when you get an income, you have to save, right? In the beginning of the month only, you should save, and whatever the money left, we can spend for our expenses, right? Meeting the expenses. So that is the F point. Let me go with the G point. Will he have to cut back on his current expenses, or can he increase his current income so that his expenses in the present and the saving for the future are met? So the thing is, he has to work out, right? So like some of you are saying retirement planning, some of you are saying insurance. So the thing is, he is getting 2 lakhs. He's just spending 1,60,000. Now he's left with 40,000. Is, the approach is correct? Okay, so we have to find those things. That means we have to work. Okay, so those things, of course, I will work on the Excel to show you, right, how we can go about finding the goal, then what should be the savings. Fine. Okay, the next is, what is the wealth X has so far built? What about the current situation? How much saving he has? So if you see the case, let me go to the case. What it says, he already has some savings, but the amount is missing, right? So I'll go to the again the situation. So the second para says that he has some savings for the tax purpose. He has some bank deposits, let's say in the form of bank FDs. He has some bonds and some mutual funds. Okay, so but the thing is, what is that amount? What is the current corpus he has? Okay, the next is, uh, how should his saving be deployed? Okay, that means where he should save the money. It's very important. What kind of investment are suitable for Vinod to build the retired corpus? Vinod means here X, Now, how much of risk is X willing and able to take with his investment? Okay, another thing is, if he is putting everything in the bank, then we should, think of mutual fund, like some of you have said stocks are missing, right? So whether we should go for the equities or completely into the debt, right? And how should X ensure that his savings and investment are aligned to the change in his income, expense, and future needs? Now, please, we have to understand, as the income increase, the expense increase. And the person attitude towards the risk also changes. So all those future, change we have to keep in, we have to consider, and then we have to plan. Okay, so some of the more points, SIPs, okay, pension, okay. Okay. So Tamil Madi, yes, he can go for pension scheme. Yes. So we have something called NPS. I'm not discussing all those products actually, but yes, there are PFRDA promoted NPS. There are mutual fund promoted retirement, schemes, portfolios out there. Some of the pension, deferred pension plan offered by the life insurer. So yes, there are options. There are certain schemes by the post office small savings scheme, like PPF is there, EPF is there, right? He can voluntarily contribute to his EPF, right? So yes, there are options. So at a macro level, what I want to say is, uh, with any given situation of a household, we have to think from all the perspective. Don't limit to certain things only, but we have to think overall. The goal planning is very, very important. Okay, now let me go to the next slide. Okay, now with the given situation, how we should move towards a financial plan, right? Now, please remember, you can see a pyramid here, right? Everyone can see my next slide. And these are the stages in a financial plan. Okay. Now, the first one, as I said, we have to work on our budgets. We have to manage our cash flows, both inflows and outflows. That is the base, right? In short, the most important things are the savings. Is it fine? So this is what the lower bottom of the pyramid is, that managing income and expenses. Otherwise, we have seen a lot of loans, EMIs, all the income goes in paying the EMIs only. Yes. And if you don't left with the savings, then we cannot create a wealth, or we cannot simply to put, we cannot meet the future goals, right? So this is the first thing. Please remember, when we are getting the income, we have to use wisely. We have to understand what is a need and what is a want. Certain wants can be postponed, right? For 6 months, 1 year, 2 year. I hope you are getting the point, right? So certain needs, certain wants can be postponed, right? Needs, of course, we cannot postpone because those are the basic necessity. But wants and desires are always can be sacrificed or can be postponed, right? So first is managing the income and expenses. Now the second one is the insurance part. It says wealth protection. So some of you have said, in case of untimely death, in case of early demise, is it fine? So how the family will sustain? So is the person have sufficient insurance? Is the person have sufficient, cover in case of untimely death or in case of accident? Like, right? Nowadays you have accidental policies, disability policies, right? So a person should always, the second thing is to protect. Like what he has to protect. It's very, very important. If he has to invest his earning, it is also part of his tax plan. Okay. So tax planning, okay. I'll go with the next part. Okay, fine. All valid point. Okay, so Neeraj, you are saying as NP as a product is comparatively new, and I have not come across any annuity announcement or annuity payment paid. Yes. So the thing is, of course, as I said, I will not discuss too much about the product, but since your point is there, Neeraj, so the thing is, NPS have two account, right? Tier one and tier two account. So tier two is withdrawable account, right? So many people take the advantage of tier two account also. And of course, tier one account, one can withdraw after 10 years, right? So that possibility is, I hope it is clear, right, Neeraj? Okay. Okay, so let me go with the third point is after the wealth protection, that is insurance. Both, we are talking here both about the life as well as we are talking about the general health insurance, right? It can be health insurance, it can be vehicle insurance, it can be accidental policy, right? So these are, we will say these are, the necessity, right? We have to protect what we have. Now the third point is wealth creation. Okay. Now, when we say wealth creation, that means meeting the future goals, right? It can be kids' education, it can be kids' aspirations, our own retirement, it can be, other tours, holidays, right? Buying a house, buying a vehicle, all these are what the wealth creation part, right? It comes under the future, meeting the future goals. And the last one you can see is the wealth management. Okay, that means it has more to do with the succession planning, right? It has more to do with transfer of wealth, right? From one generation to the next generation, right? We call it intergenerational wealth transfer. Right? Now it can be through will. Okay, it can be through, it can be building a trust, right? And of course, managing all this, we have to take care of the taxation part also, right? So some instruments are taxable at marginal tax rate. Suppose if the person is in 30% bracket, then the tax applicable is 30%. The best example is the FDs, right? So if X is earning 2 lakhs per annum, right? That means he is in 30% tax bracket. And hence, if he goes for the bank FD, he has to pay 30% on the interest. Very simple. But there are certain instruments, where it is deferred in nature. Like we are talking about NPS, that is deferred in nature. When we talk about equity, it is only on gain. We call it capital gain. It is taxable. I hope you are getting the point. So estate planning is, yeah. So Jagam, right? So Jagam, you are asking what is estate planning. So please understand, as I said, estate planning means from one generation to another generation. Let's say from father to children, right? Or let's say from grandfather to father, how the wealth is transferred. Okay, how the wealth will transfer. Okay, that is estate planning. So it can be through will, right? What we say in Hindi is wasiyat, right? We prepare a wasiyat, right? So we prepare a will, right? It is a person will to gift, right, the property or asset to the next generation, or whomever he wants to, gift it, right? So that is all estate planning. I hope it is clear. Okay, so another good point is one is saying EPFO. Yes, I already said, I think employee provident fund, and one can voluntarily also VPF more than 12% contribution. Okay, gratuity funds, please understand. Now, gratuity fund is as per the gratuity payment of gratuity act 1972, right? So those formulas are fixed by the organization. I hope it is clear, right? Liability protection, yes. Suraj Ghodke, yes. Liability protection, yes. So it is also in some case professional liability like doctors, accountants, right? Architecture. So professional liability, director's liability. Okay, good, valid point. So you are getting the point. What what we understood is financial plan is for everyone, and everyone's situation is different. But at a macro level, what are the stages, right? So these, what the pyramid you are seeing, these are the stages. So first is managing your inflows, outflows. Okay, you have to protect your assets and yourself using insurance. Okay, then we come to the goal planning and meeting the goals, future goals, and then ultimately managing all the things, right? All the wealth. I hope it is clear, right? Now, next, what I will do is, which is very important to understand, is now this slide, it talks all about the risk management. Okay, what about the ULIP, right? So I will not comment on the ULIP. So Hemendra, right? Hemendra. So, Hemendra, I will not comment on anything on the ULIP because it becomes more like a product promotion and all those, right? Here we are to learn the fundamentals of the financial plan. Now, ULIP, as I said, depending on the situation, right? For someone, it can be good. For someone, it is not suitable. So suitability depends on the person to person, house to house, right? So I will not go. It is, I'm not here to do any kind of advisory. This you have to understand. Okay, now let's go to the very important part. Okay, and this slide is all about the risk management. Okay, how we should manage the risk. Okay, so you can see here 4 quadrants, everyone, on the slide. Okay, now on the x-axis, you can see the impact. On the y-axis, you can see the probability. Okay, probability here means the chance. And if you see from 0, right, where the axis meets, it is written low, right? And as we go further, you will find it is written high. So low impact and high impact, and low probability and the high probability. Is it fine? That means low chance and high chance, low impact and high impact. Now here impact means financial impact. Please understand, here impact means monetary impact. It can be low financial impact. It can be high monetary impact. Okay, now probability means, that event that will happen. Low chance and it will happen. There are high chance. That is the probability. So understand these 4 quadrants. Okay. Now the thing is, if the financial impact is low and the happening of that is also low, then we should accept the risk. Okay. This is all about risk management. Is it fine? We should accept. We call it self-insurance. Fine. For example, if I take an example, if I am driving my vehicle at 40, at a speed of 40 in a city, as per the Motor Vehicle Act, right? I'm following all the guidelines of RTO. Is it fine as per what the license guidelines are? If I'm following the guidelines, I'm putting a seat belt, or if it is a two-wheeler, I'm putting a helmet, not using mobile, I'm following all the norms. The impact is, the chance of accident is less. And if it happens also, then the impact will be low because I am in control of my speed. Is it fine? In that case, we accept it. Something like, if suppose if accident happen, and if if there is a fracture, it can be managed, right? That is a self insurance. Okay, so Sayani, it's like a SWOT analysis. Yes. Okay, Sudha, you are saying, can we start planning all stages simultaneously or one by one? See, the thing is, I think step by step is more important when you are starting your career. Okay, you manage first your inflows, outflows, you look for the insurance, you look for the wealth creation, and then you look for the all the tax and estate planning, right? So if it is followed step by step, it is better. Once you have the experience, then of course everything goes together, right? Now please understand. So I was at the point, accept it. We don't need insurance for fracture. Nobody will give the health insurance policy on fracture, right? Same way, we don't get insurance on the dental, right? If I go to the dentist, I know it is very expensive, right? If I go for a root canal, it is an expensive, right? But we don't get insurance on the dental surgery part, right? Unless and until it is a major accident and the whole jaw is damaged, right? Those are the part of the policy. Uh, okay, now next is, just think, if the probability is high and the impact is low, then we should reduce it. It's very simple. There are, I have seen many people who ascend or descend the stairs, right? They go upward or they descend the stairs very fast. Of course, it can be a fracture. A young people can, the foot can, he can slip, right? And he can have a fracture. Now, that time, what we have to do is we should not do that activity. We can reduce, right? We can change our habits. We can reduce, right? So again, we don't need the insurance. Now the impact is high and the probability is high. The doctor is saying that don't go for tobacco, don't smoke, avoid alcohol, right? Don't drive fast because the impact will be high, monetary impact will be high, and the probability is also high. Avoid it, don't do it. Because even if we have an insurance and if the insurance company found that the person is drunk and driving, the insurance claim will be rejected. Okay, the contract becomes a void contract, right? Because we are not following the terms and condition of the insurance contract. So avoid it. And the what you are seeing in the yellow color, okay, we call it transfer. Okay. Now here the transfer means what? Transfer to the insurance company. When the impact is high, but the probability is low, right? The chance of happening is low. For example, death, the person dies only one time, right? The probability is low, but the impact is what? The family will suffer, the future goals will be suffered, right? And that time we need the insurance. So transfer of risk to the third entity, we call it insurer, right? That time we definitely look for the insurance. I hope it is clear. Any question on this? Most welcome. Or any point you want to put? Okay, so Devansh, so don't understand. So Devansh, I think you missed it. We are talking about the risk management when we should consider the insurance, right? So insurance is most desirable when the impact is high and the probability is low. When the monetary impact is high and the probability is also high, then we should avoid that activity. It can be rash driving, it can be, use of tobacco, it can be unhealthy diet, so all those. uh, this what you say, continuous sitting, right? All this lifestyle, right? All this. So we should avoid that because the probability is very high that we will have some kind of lifestyle disease. It can be diabetes, it can be high cholesterol, right? All those things should be avoided. Even insurance company don't prefer where the probability is high and the impact is high because it goes into the catastrophic in nature for the insurance company also. I hope it is clear. Yeah, so others, what you are saying, insurance is all about the transfer of risk. Yes, so transfer of risk to the insurance company, and insurance company also prefer when the chance are low and the probability is high. Sorry, when the impact is high. All right. Okay, I'll go to the next part. Very important. Now I will come to the wealth creation part. I hope everyone can see. See, if you have any question, you are most welcome. Don't raise your hand. You can put in the chat box. I will check. Okay. Now, Vijay Gore, you are asking how much insurance one should have. Okay. So there is something we call it discounting process. You can write. Okay. Now, discounting means we have to discount our income, right? Or we have to discount. So I'm not getting it. Example only in the last slide. All right. So I will show on the Excel sheet. Don't worry. I have the Excel sheet ready. I will show you what should be the insurance, and then what about the goal planning. Those things I will show on the Excel sheet only. But first, again, go with the basics. What are the opportunities available? I hope you have any question with respect to this, please let me know. So I'm starting with the basic, the most favorite of Indians. We call it gold, right? It can be a physical gold, it can be a digital gold, we call it dematerialized, it can be sovereign gold bond, it can be gold ETF, gold mutual fund. Agree, everyone? Okay, so I'm okay. Discounting cash flow method. We have to use, yes. So Sanket, you are correct. I will show you on the Excel sheet how to discount the expenses or income to find the sum assured, right? How much insurance we should have. Otherwise, in the market, what the thumb rule is, people say 10 times of your salary, but we go in a scientific way. Just wait for some more minutes. Okay, so this is a gold. We have the fixed income instruments, something like FDs, EPF, PPF, bond, debentures, debt mutual funds. Okay, we have the life insurance, we have the saving plans and the endowment plans. I think all the life insurance company offer savings and endowment. And one of you have asked me just now the ULIP. So ULIP is also one of the option. Okay, when it comes to the real estate, it can be land, residential property, commercial property, physical. It can be in the demat form, something we call it real estate investment trust and infrastructure investment trust, right? Those are also the options available. And of course, with the equity share, we can directly go with the equity. We can have a demat account, trading account, and we can buy directly through our trading app, the direct equity shares based on our analysis, whether fundamental or technical. We can go with the equity mutual fund. We can go with the portfolio management services, right? So these are the various options available. Okay, now the thing is, I have written one more. Can you see starting with the P, everyone? Okay, so Adarsh is asking decreasing value of gold, how benefit if I invest today but get returns in lower value in the future? So please understand, we have to understand one thing. You know, these are the securities or these are the asset class and the asset value fluctuate. So there is no guarantee. I hope others it is clear, right? So we cannot guarantee for any product. Even we cannot say a tentative returns also. Are you getting the point? Digital gold, yes, I have written. So Subhash, so Saurav is saying P for pension. No, 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 no. Not pension. There is one more asset class. No, 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 no. You can see P and there are four asterisk sign, right? You can see four stars. No, PMS and all those are the part of equity, right? So it's not art. It start with P. Okay, so we call it. Okay, so I'll save time for everyone. Okay, so the thing is, okay, so Tamil money, you are asking what about the real estate dematerialized? Yes, so we call it real estate investment trust, right? Something like mutual fund only, and our money goes to the fund manager invests in the commercial, right? P2P lending, okay, nowadays, yes, it's a hot topic, right? People go with the P2P, peer-to-peer lending, fine, Gupta P. Okay, so P stand for, I will tell you, and intentionally I have written like this. Now here the P stand for Ponzi, Ponzi. Okay, P stand here for Ponzi, Ponzi. Ponzi schemes, right? People invest in Ponzi schemes also. And that is, please, we have to understand those are unregulated. Those are really very dangerous, right? Those are unregulated market, and we should always refrain from such Ponzi schemes. The schemes which promises all those guarantee returns, fixed returns, those are Ponzi schemes. Is it fine? Except the NCDs and FDs, right? Where there is a guarantee, right? Where there is kind of assurity. So I'm not talking about fixed income instruments, but other than the fixed income instruments, wherever you find any guarantee on the securities, those becomes the Ponzi schemes. Those all are unregulated. I hope it is clear, everyone. Yes, so not necessarily higher returns. See, even if a bond having a low credit rating can also offer the high returns, right? We have seen a rating of triple B or double B can offer up to 10%, 11%. Again, I will not say credit cooperative societies. Most of the cooperative society or cooperative banks now they are under the RBI, right? So I'm not commenting on that. But the thing is, there are Ponzi schemes which are unregulated in the market. Local, money lenders at a local level they float. A lot of scams happen. So please refrain away from all those schemes, right? Don't consider those schemes. I hope it is clear. Let me move to the next part. We are short of time. Okay, so risk measures, and what I will do is I will share my Excel sheet now. I hope everyone can see here. Excel sheet is visible, right? Okay, so others alternative funds, no, alternative funds, AIF are registered with the SEBI. They are well regulated. There are regulations, right? AIF regulations 2014, right? So they are well regulated. Okay, now let me come to the so I will be discussing on two things. One is goal planning, and second, what you ask is the insurance sum assured. Right? So I will be discussing on two things. So you said like you asked right how we can go with a goal planning and insurance sum assured. Both include the same concept. We call it compounding and discounting. Okay, some of you might know what is compounding and discounting, but let me go with it. Maybe you will be able to recall in some part of your life you studied this thing, right? So first thing is I'll go with the goal planning, right? So first thing is I have to define the goal, right? For example, my goal is retirement corpus. Okay, I have to build a retirement corpus. Is it fine? So I have to build a retirement corpus. So how I will build the retirement corpus? It's very simple. I have to take my current age and I have to take my retirement age, right? And the thing is, what the current age is. For example, I'm just assuming my in the sense I'm just saying X, right? We are discussing a case of X. So what the thing given is X age is 40 and the retirement age, let's say it is 60. All right. And then what we have to do is uh, what is the year, right? What is the pre-retirement period? So it is something like 40, 60 minus 40. Is it fine? And we have 20 years. And now the thing is, how much money he needs, right? What is the money need if he retires today? Okay, so what is the monetary or money need if X retires today? Okay, this we have to find. So I'm assuming, for example, I'm just putting here that suppose if he retires today, okay, we have to take the current period, right? If he retires today, then he needs, for example, 50,000 per month into 12 months, right? So it comes to 6 lakhs per annum. And now next we have to please consider is what is the inflation, right? Like for example, if you see today's Times of India, what the rate of inflation given in today's Times of India first page, right? Today's edition, it was given as 5.5%. Okay, this is what the inflation I'm giving you, quoting the latest figures, right? So 5.5. And the thing is, what we have to do is we have to find what the future value of expense, okay, when he retires. We have to find this. And here we are going to use the compounding uh, formula, right? So I'm just going quickly with the compounding formula. Okay, this Excel sheet, of course, I will say you will get from my colleague Amir. Fine. So I'll go with the formula. And what we are getting is today it is 6 lakh. When he retires, he required how much? 17 lakhs 50,000. Okay. And now next, very important, you know, now this is somewhat debatable thing. What is the life expectancy? So we have to take some number. Please understand, on papers, we have to take some number. Okay. So again, depending on the person, right? What the health condition is, what about the family history, right? Some family have hereditary disease, right? It can be high cholesterol, blood pressure, it can be other, lifestyle diseases like diabetes. So some people know, right? What my family history is. So one hint can be that. So what about the life expectancy? For example, I'll take 80 years. So what about the post-retirement period, right? And it is something like your 80 minus 60. So 20 years. Is it fine? And now he expect that he will get some returns. And now we have something called post office scheme, senior citizen scheme, right? We have post office time deposits, then monthly income plan. I hope you heard all this. Then you have mutual fund, systematic withdrawal plans, right? All those are the options available for the retirees. You have Pradhan Mantri Vai Vandana Yojana. There are so many options for the retirees nowadays. Okay, so Nidhi is saying 75 years. In the absence of any information, we can take 75. Fair enough, Nidhi. Okay, so I can go with senior citizen scheme, something like, let's say 7.1%, right? So this is the return expected. There will be inflation even in the retirement. There will be returns. And now we have to take, we call it inflation adjusted rate, or this is known as a real rate. Okay, so I'll go quickly with the formula of the real rate. Means there is a common rate between a return expected and the inflation. All right. So, sorry, I got disconnected. I am sharing the screen. I hope everyone can see the screen.
Yes, sir.
All right. All right. Thank you. So the thing is, I just put off my video off because of low bandwidth. Okay, but I just focus on the numbers, right? So just a quick recall that how we can plan, right? We call it goal planning. So I'm taking the X example only, what I've shown you on the slides, right? So current age is 40, retirement is 60. The pre-retirement period, we have done 60 minus 40. And I assume, let's say if he retires today, then per month he requires 50,000 and into 12 months, it goes to 6 lakh, right? Again, I have taken today's RBI data, front page of the Times of India today. The inflation given is 5.5%. And the first step, the first calculation, what we did is we found the future value, right? Using the compounding formula. So it goes to 17 lakhs 50,000. And then I assume 80 years. Some of you have said the average Indian age is 75. We can take 75 also as per the family history. Then what the post-retirement period is 80 minus 60. It goes to 20 years. And then let's say I'll go with some senior citizen scheme rate, which is 7.1%, right? Or 6.9, I guess. I'll go with 7.1. Okay, now these are the things. And the next what we have to find is the real rate. We call it inflation adjusted, right? So what is the inflation adjusted rate? And here, again, quickly, I'll go with the formula, which is your nominal rate or the returns we are getting. And we adjust the inflation to it to have a compounding effect. And what we are getting is, over and above, like one of you have said in the beginning to beat the inflation, right? So if inflation is 5.5 and returns are 7.1, then what is above the inflation rate is what the person is getting is 1.51. I hope it is clear, right? So this is the rate. Let me reduce. Okay, so this is the rate. Now, next is what we have to find is the corpus, right? How much retirement corpus one required. And I said the term discounting, right? So we'll discount using the real rate, okay? So discounting means finding the present value, right? So I'll go with the PV function. This is the real rate. And then number of period is 20 years. Every year, it is 17.50. Of course, inflation adjusted. So real rate will take care of it. Okay, and like that, for example, I assume in the beginning, mostly retirees need the money in the beginning. So I'll go with the one. And let's see how much money is required. And if you see the figure, it goes to 3 crores, 4,062, sorry, 4,62,000 and 350. So this is a systematic way of calculating the corpus. Okay. Now, another thing which is just related to it is the insurance sum assured, right? Now, as I said, there are rule of thumb rule which says 10 times of your income or 15 times of the expenses. Okay. But again, we can go in a scientific way and the same process, the discounting process to calculate the insurance, life insurance sum assured, the same process. Okay. So, the thing is, again, what I will do is, let's say I'll take the case of this X only. Okay, let me copy this. Uh, I'll go like this. Okay, I'll copy the same data, at least the variables. So age is 40, retirement age is 60, pre-retirement period, or I will say earnings year. Okay, so here the wordings will change. So earning years is 20, inflation I'm taking 5.5, and returns, let's say I'll go with again 7%, right? Or I'll go with a average FD rate, which is as of now it is 7 or 7.1%, right? So I'll go with 7%. And same fundamental, right? I'll go with the real rate, which is your again, inflation adjusted. Okay, so what we are getting is 1.42. Now the thing is, the variable I change, right? When the person dies, the household should meet the expenses. So again, I'll put the expenses, or better, I'll put the family need, what the family need is, right? So suppose if the family need is, for example, I'll take 5 lakhs per annum, right? Then what should be the sum assured? And the same process will go with discounting all the future family needs. So again, the rate will go with the inflation adjusted, and per will be uh, 20 years. Your PMT periodically, what the annuity or the funds required by the family is 5 lakhs. And then again, the funds are required in the beginning. And what we are getting is 87 lakh 73,858, right? So this is how you calculate in a mathematical way the sum assured here. Uh, any doubt? Okay. Yes. So Archana, you are asking for Excel sheet. Yes, I will save the Excel sheet. Of course, you will get the Excel sheet. Is it fine, everyone? You have more question? Yeah, most welcome, please. All right. So if no question, then can we stop then? Okay. So yes. So nowadays you are asking how you arrive on family need. Okay. Now the thing is, okay, good. Okay. So I hope I'm audible, right? Okay. So how you arrive on the family need? Now please understand what Sachin you are asking. Family need, I have assumed, right? Now practically how you will come to the family need. So you have to see what are the household expense. Okay, including what about the education fees? What about the emergency required, right? So you have to consider what the ongoing expenses are, and you have to add certain kind of certain discretionary also. Means in case of emergency, you have to add certain amount of emergency also. So that becomes the family need. So everyone have a different, right? It is not absolute 5 lakhs. For some, it can be 10 lakhs. For some, it can be 3 lakhs also. Okay, if my age is, so Sumit, if my age is 48 and if I want to retire at 50, then how much corpus I need? Okay, now please understand, if my age is 48. So again, good Sumit. Okay, so Sumit, you are presenting a situation. And as we have discussed in our slides, okay, so let me again share the slides. Just a minute, I'll open it. So if the person age is 48 and he wants to retire at 50, right? Then what about the corpus? Okay, so what the things I want to highlight here is, okay, just a minute. Huh? I'm sharing my screen, the PPT. Okay, now the question is, if the age is 48 and want to retire at 50, what is the solution, right? What is the corpus required? So like how the X cases, right? We have to consider the same thing. What about your, already saved money? Where your money is lying, right? What is the life expectancy? What are the expenses after 50? Now the thing is how to calculate, how to go about it. So first thing is, you have to at least write what you can see. That means what are the future expenses when I retired? What are the expenses? It can be regular expenses. It can be healthcare. See, when the person progress in age, when the person becomes senior, there are some healthcare issues also. So what about the medical expenses? Because everything is not covered in the medical. mediclaim policy, right? Even like suppose if I say the person have a cataract operation, right? The eye cataract operation. Now it is not 100% settled. The policy clearly says 40% or 50%. Is it fine? So we have to take into account after retirement what can be the probable unforeseen events can happen. So those values you have to consider. And the same process, like how I did on the Excel, we have to discount all the future values and find the corpus. Okay, yes. Prinshu, you're saying, so do we consider number of working members in family while considering? Of course, yes. How many family members? It can be dependent, it can be independent, right? So you have to consider the whole family members because they are the family, right? We are doing for the family only. So you have to consider all the family members and you have to come to the conclusion on the amount, right? There are there are four members in a family or six or two, and you have to take into consideration the aggregate of all the members, right? So yes, entire family we are doing for the family only. Okay, most of the investors say we do not have money. Okay, see, everyone have the money. It's not like they don't have the money. I'll give you a good case. Like if you go to the agriculturalist, right? They say we have income only for 3 months or 2 months, right? But the thing is, whenever they have the income, they get the lump sum amount. And maybe you heard in the mutual fund, we call it STP, systematic transfer plan. So of course, one can go with the STP in case of casual business, in case of agriculture, in case of uneven. Mostly it is very common in the business, right? In case of uneven cash flows, one can always utilize some strategy like SIP, STP, SWP. Those are really good. That's why they are there in the market. So those people are aware of STP usefulness. They definitely use. They don't give the excuse, I don't have the money. Yes. So, Kaushik, you are asking? Yes, of course. What is SIP? So, in short, I will say that when we invest a certain amount, a constant amount every month or every week, that is a systematic investment plan, which is very common in the mutual fund. It can be in insurance also. It can be in post office scheme also, right? So SIP is a systematic investment plan where the money is uh, regularly, periodically invested in certain asset class. Yeah, so Swarnava, yes, very good. First debt and then STP. Okay, good. So the thing is, REITs, Real Estate Investment Trust, as I said, it is like like a mutual fund only where money is invested in the commercial property and the rent is shared with the unit holders, right? So those are real estate investment trusts. Okay, Sukanya Samriddhi scheme, yes. So Sukanya Samriddhi scheme, Bhagyashree, yes. For the daughters, right? For the girls, for the daughters till the age 21. So good one, yes. Of course, you should avail all the government schemes, recognized government schemes, not the Ponzi one. Okay, STP. So Sanket, you are asking STP. So what I will say is, since we already exceed the time, I will say systematic transfer plan. That means from one fund to another fund, right? So people say, I don't have the income or regular income. Whenever you get the income, you invest in debt, right? Some debt fund, it can be bond fund, it can be debt fund, it can be money market funds. And then that lump sum amount, when invested, can be transferred to something like balance fund, equity funds, index funds, gold ETF, right? See, again, don't ask me which is good or which is bad, or, uh, in my opinion, everything in the market which is there, that means there is a need, right? We have to just see what our situation is. So financial planning is circumstances basis. Everyone is into different circumstances. So please don't ask which is good or which is, everything is good. We have to see the suitability. Is it fine? Okay, physical gold and ETF. See, these are the pros and cons. The thing is, if I don't need the gold today, definitely I will go with the ETF, right? It is secured, digital, the storage cost, there is no storage cost, right? But when I need a physical gold, right? If I want to have a jewelry or if I want to gift, right? That time I need a physical gold. So we can, of course, redeem the ETF and go to the shop and have a physical gold. Okay. Uh, Amir, hello. So is it fine? I think. All right. So then I think we have covered all the basic elements of financial plan and that risk management matrices also. So thanks everyone. Thanks Amir. Thanks NISM, SEBI for this opportunity.
So thank you for giving us a time actually. And besides the way very hindrance, you have covered the topics very well. So now just give me some time to officially close giving the closing remarks and thanks you on proper manner.
Fine, fine, sir.
Yeah, so nevertheless, you have taken the time and thank you for your insightful session for today's like the topic on financial planning and risk measure. So special thanks to you because you have break down such complex topic into the pieces so that everybody can understand what are the modes of investment, what are the risk measure involved in that. So that and we can plan accordingly what calculation, what are the things we need to take. And you have also guided us on effectively the manage finances while accessing the risk. So that's you're thoroughly covered by the practicality and calculative manner. And last but not least, thank you for all the participants who are attending the today's webinar. As your question and the engagement was very well received by our speaker as well, and will be I hope you have answered all the questions you have been asked. So thank you once again and stay financially empowered. So and thank you Rohit sir for your time
Yes,
and
yes.
valuable inputs for that.
Yes, thank you. So I will share the PPT as well as I will share the Excel sheet on the mail, which can be, of course, forwarded to the participants.
Sure.
Fine. Thank you. Thanks, everyone.
Thank you. Thank you everyone. Have a nice day.